Ladies and gentlemen, I know you're enjoying your lunch, and please continue while we start our official program, the official part of the program, as we recognize once again the 2013 Global Citizen Award for the President of the Federal Reserve Bank of Richmond, Jeffrey Lacker. At this moment, I would like to also recognize some others that they have received this award in the past, and this is the President of the Federal Reserve Bank of Philadelphia, Charles Plosser, who is with us, and Bill Dangelberg, who served as the chairman and chief economist of, chairman of GIC and chief economist of the National Federation of Independent Businesses. So, President Plosser and Dank, thank you very much for joining us today. At the same time, I want to bring to your attention the fact that we are concluding this year's programs with a very interesting program in Philadelphia, the Federal Reserve Bank of Philadelphia, which deals with women and risk. I encourage all of you to participate. It's a unique program in the sense that we focus attention on women's attitude about risk, as opposed to leadership attitudes and issues associated with women's engagement in the business world. So it's an interesting program, and I encourage all of you to participate. GIC's activities would be impossible without the support of the board, and I'm very privileged to have the opportunity to work with board members that some of them are here with us today. I would like to recognize them. Peter Burns from Heartland Payment System, Ben Leavenworth from Afina Holdings, Bill McLaughlin and Morgan, Herb Taylor from the Federal Reserve Bank of Philadelphia, and unfortunately Mike Drury, who is really our vice chair on programs, is not with us today, but I would like to recognize him because he has done an exemplary job in our programs. For all of them, a round of applause, please. But there is one important member in our board that I need to especially recognize, and this is Paul McCauley. Paul has been on the board for a number of years. He has been a speaker to various events and activities of GIC, a great supporter of GIC, a former senior partner at PIMCO, and should I say a media personality, perhaps, an individual who has given or granted so many interviews in the business media, and an individual who has coined really the two terms, the Minsky moment as well as the shadow banking system. Paul is not only involved on practical matters in the financial markets, but also he has intellectual pursuits and philanthropic pursuits, and he spends his time with work on foundations and with his alma mater, and he is doing an exemplary job as a promoter of GIC. And for this and many other things, I would like to ask Paul to join me as he introduces our honoree for the 2013 Global Citizen Award. Paul?
Thank you, George. The media personality sitting right over here. Hi, Charlie. How you doing? Squawk Box this morning. I haven't been on Squawk Box in 6 or 8 months. Thank you for being here. It's a great honor to be here to celebrate Jeffrey. I was reflecting over the time that I followed his career. We're not all that much different in age. And now he is obviously the president of the Richmond Federal Reserve, the 5th District. And he moved to Richmond. He wasn't president in '89, but he moved to Richmond in 1989. I actually left Virginia in 1979. I grew up 100 miles from Richmond down in Stanton, Virginia, right down the road. So I was thinking in terms of just, small world it is that I grew up 100 miles more or less from where he has spent a good chunk of his career and is now doing a wonderful job for a number of years as the president of the Richmond Fed. And the reason I was thinking about that sort of thing is most people who wouldn't know us think in terms that we wouldn't have anything in common, because he tends to be a hawk and I tend to be a dove on the avian perspective. But those of us who are in the arena for a long time can actually argue each other's position. We just end up taking a viewpoint. It's not that we're alien to each other whatsoever. We just actually happen to come to a different conclusion, but we all use the same sort of framework. So I been focusing, and I think in terms of introducing Jeffrey, on our commonality. And obviously Virginia is a incredible source of closeness. And in fact, the Society of Fellows at the GIC had its annual event in Richmond this year, because I wanted to do it in my home state. And Jeffrey Smank was wonderfully supportive. He gave a keynote at our conference. And what is more, the conference was at the University of Richmond, where I know the dean very well from Grinnell College, and he is actually on the board of trustees. So one of the benefits of growing older is you grow deeper and deeper friends across all perspectives of the world. And Jeff is that. And I just learned today that actually my brother lives, but I didn't learn my brother lives in Lancaster. I know that my brother lives in Lancaster. He has for 25 years. But that actually Jeff went to undergrad outside of Lancaster. So it's a really wonderful to have him here to honor him. And he has been a wonderful supporter of GIC going back many years. In fact, he went on a GIC mission to Israel right after the Minsky moment of 2008, and is actually with us last year in Poland, and was a wonderful co-host in many respects for my event in Richmond this spring. So it's absolutely delightful to have Jeffrey here, and also to honor Jeffrey with the award of Global Citizen. Please come up, Jeff. Thank you.
Get a small momentum.
And I think they want a photo op here.
Excellent, let's do that.
My high-tech camera.
High-tech camera.
All right, one more, and we are good. Thank you so much.
Great.
Thank you.
Thank you.
Enlighten us, Jeff. Thank you.
Thank you very much, Paul. Because of my deep respect for the ideals and mission of the Global Interdependence Center, I am very honored and very humbled to receive this award as Global Citizen. Like virtually all economists, the considerable benefits of the open exchange of goods and services and ideas and people internationally is, to me, just self-evident. So the mission of the GIC is to improve cooperation and understanding among nations with the goal of reducing international conflicts and improving worldwide living standards. This is one I support with enthusiasm. I have my own historic link to the GIC as well. From 1977 to 1979, and then again in 1980, that summer, I worked at Wharton Econometric Forecasting Associates, fondly known in the day as WEFA. This was an outfit where I was working under Professor Lawrence Klein, who passed away nearly a fortnight ago. Professor Klein, besides being a Nobel laureate and an econometric pioneer, was an early GIC leader and was most recently vice chair emeritus of this organization. I knew him as a dedicated researcher with an utterly amazing command of macroeconomic facts. I recall seeing him walk to a podium with a small scrap of paper on which he had jotted 3 or 4 of that day's statistical releases and talk for an hour with no other notes on the economic outlook in all the major industrial countries. Just amazing. But I also knew him as a soft-spoken and humble man. When I knew him back in the day at WEFA in the late 70s, we worked in West Philadelphia, he drove a Dodge Dart. And frankly, I suspect very few Wharton professors drive Dodge Darts these days. There's a deeper connection, though, as well, to the GIC, and this is what I'd like to explore with you today. Global interdependence is essential to understanding the institution at which I've made my career, the Federal Reserve System. When the Federal Reserve Act was signed nearly 100 years ago, it would be 100 years ago this coming December 23rd, to remind you, the continued operation of the classical gold standard was presumed, and our institution was designed around the need to sustain that. Less well known is the extent to which competition in the business for international trade finance played a key role in the passage of the Federal Reserve Act and some of the most noteworthy institutional features of the Fed as well. And of course, during pivotal episodes in our history, international monetary considerations played a decisive role in shaping decisions we made and the events as they unfolded. More recently, the U.S. financial crisis of 2007-2008, part of which I spent in Israel, a week of which I spent in Israel. And the events that led up to that, you really can't understand that without an appreciation of financial institutions and economic policy abroad. So I think it's fair to say one can't tell the full story of the Federal Reserve System without an international perspective. And I can also say I can't tell the full story of the Federal Reserve System without the usual Federal Reserve disclaimer, which is that the views expressed will be my own and not those of my colleagues in the Federal Reserve System. The international dimensions of central banking have long been recognized by specialists, but they get less attention in the popular media coverage of the Federal Reserve than they deserve. At the founding of the Federal Reserve, international considerations were twofold. The first was the fact, as I mentioned, that when the Fed was founded, the U.S. adhered to the gold standard. Governments of participating countries stood ready to convert their paper currency into gold at a fixed rate. And under this system, the long-run stability of the purchasing power of money was assured as long as the U.S. and the other countries adhered to the rules of the game, as it was said. These rules required that countries allowed gold flows arising out of balance of payments gaps to have an appropriate equilibrating effect on domestic economic conditions to maintain that gold standard parity. The Fed was envisioned as operating within and facilitating adherence to the gold standard. Now, price stability was important as a goal to the founders of the Fed, but it's one they expected, and it's one they expected the Fed to contribute to, but their focus, because the gold standard was essentially assuring price stability, their focus was on something else entirely. It was to solve the currency problem. Now, this is an unfamiliar term to modern ears, so it deserves a bit of explanation. Before the founding of the Fed, paper currency was supplied by national banks, nationally chartered banks, and it was subject to a collateral requirement that dated back to the Civil War. Banks' note issues had to be backed by holdings of U.S. government bonds, and this feature of the National Banking Act was what helped finance the Civil War, or as a friend of mine in Richmond likes to say, helped finance half of the Civil War, not all. It's appropriate here to note that, right? I was told, by the way, not to wear a gray suit to the Union League. I see some gray suits in the audience. Being from Richmond, I felt I had to respect that. So the aggregate supply of notes, because of this collateral constraint, was a little sticky. It was described as inelastic. And the reason was expanding the note supply was really cumbersome. You had to go out and buy a bond, which was kind of complicated then. You couldn't do it online. And you had to get it to the Treasury, and then you had to ask the Treasury to print some more notes and ship them to you. It was a cumbersome process. At times, the public demand for notes rose as the public sought to convert deposits into paper notes or coin, or gold coin, but mostly into paper currency. This typically occurred during the autumn harvest season and during the holiday shopping season, I might add, as well as during so-called banking panics. They called them banking panics then, not Minsky moments. And these were times when, famously, bank customers tried to pull their deposits out in the form of cash. The inelasticity of the supply of banknotes meant that other adjustments had to take place instead. Interest rates tended to be higher in the fall and winter. This is sort of bizarre to our mind these days, but 100 basis point spread between interest rates in the spring and interest rates in the fall. They tended to spike during these banking panics when the banking system was scrambling for currency to pay out to their customers. Significant inflows of gold from abroad occurred during those times as well. And this is sort of bizarre here that the seasonal demand for holiday shopping in the U.S. should lead to gold flows from Europe to help finance. It's a little bit odd. So you can think of it this way, that imperfections in the U.S. banking system caused domestic money demand shocks to be transmitted throughout the international financial markets. Another adaptation that the system made to this regulatory constraint on note supply was payment suspensions. Banks would at times just prevent their depositors from getting their whole account out all at once. At times, the banks in a city clearinghouse would band together and suspend withdrawals, although they would allow transfers between clearinghouse banks. But these were adaptations, natural adaptations to the increase in demand for currency at times like that. But they were disruptive, and they were a dysfunctional feature of the pre-Fed system, and the reformers were just avidly interested in preventing these from happening again. So, the preamble of the Federal Reserve Act lists as one of its purpose, the first purpose listed, is to furnish an elastic currency. And that's what the elastic means, that the supply can vary with demand. The ultimate objective can be thought of as keeping the defective legislative framework around U.S. banking then from damaging domestic and international markets. So I said there was another international consideration, it's this. Following the panic of 1907, an influential group of New York bankers were instrumental in the campaign for the creation of a central bank in the U.S. The group included Benjamin Strong, as an associate of J.P. Morgan at the time, and later became the first head of the Federal Reserve Bank of New York in the 1920s. And it included Paul Warburg, the German financier, who was at Kuhn Loeb at the time. They broadly shared, with a number of others, an internationalist view that America had emerged as a world power and should play an expanded international diplomatic and economic role. Creating a central bank was, for them, integral to promoting the U.S. role in the world economy. For this group, Europe provided the natural institutional models for founding a central bank. Many were familiar with the central banks of Europe, particularly Warburg, whose family stayed behind in Germany and was active in finance there. In a number of European countries, the central bank issued their own notes, accepted deposits from banks, like the Federal Reserve does, and that enabled them to rapidly expand or contract the supply of notes in response to fluctuations in demand. Liabilities were at least partly backed by gold, either in the form of coins or bullion. So the Federal Reserve Act included at the time, this has since been abolished, but it included a 40% gold cover requirement so that the Reserve Bank's money supply would tend to expand or contract with the movement of gold into and out of the country as required by the rules of the game under the classical gold standard. While these New York bankers were concerned about the currency problem and eager to solve that problem, a second critical motivation for the founding of the Fed was a desire for New York to supplant London as a center of trade finance. One provision of the Act allowed national banks, nationally chartered banks, for the first time to issue bankers' acceptances. These were a type of commercial paper, generally 3 to 6 months in maturity, sometimes longer, but about 3 to 6 months. And they arose out of financing international trade flows. So an importer would order some goods, need to pay the exporter. Exporter wanted cash before they shipped the goods. The importer would draw a note, sort of write an IOU essentially. So it's an obligation of the importer, but it would be accepted by a bank, meaning that the bank guaranteed payment. At that point, it becomes a pretty safe instrument and can be sold on a liquid market. Prior to the Federal Reserve Act, banks in the U.S. were generally not allowed to endorse such instruments, and so the market for these coming out of U.S. banks was virtually non-existent. So this led to this weird situation where an American importer ordering something from Latin America would finance it by drawing on a London bank. Made no sense to these people. Creating a New York market in bankers' acceptances helped promote U.S. trade in the world, made those costs of getting deals like that together lower. But it also brought a lucrative business to the New York banks. European banks at the time, central banks such as the Bank of England, bought or lent against such instruments. They would buy them outright, or they would lend against them as collateral. That process was called rediscounting. So it was discounted once when the banker sold it, and then rediscounted again. That provided some backstop of support, and that was thought to be essential to the liquidity of a market for acceptances. Indeed, according to Warburg, the central bank and the discount system cannot be separated. They are absolutely interdependent. It's something I think is debatable, but that was the view at the time. So another purpose of the Federal Reserve Act, the one that comes right after elastic currency, is to afford a means of rediscounting commercial paper. And this is what it means, getting the bankers' acceptance market going. The reserve banks were authorized to rediscount a variety of commercial paper as long as it wasn't backed by stocks or bonds, which were viewed as speculative and risky investments and inappropriate for banks. And they were also authorized to make outright purchases of bankers' acceptances. So a little detour into arcana, but important things having to do with the motivation for the founding of the Fed. World War I did a whole lot to reorder the international financial system. But among those changes was a significant shift. They succeeded in bringing the bankers' acceptance market to New York City. So by the 1920s, thanks to the active encouragement and support of the New York Fed under Benjamin Strong, the New York acceptance market had grown quite significantly. So let me go through Fed history, take you up to the present day. The demise of the gold standard played a pivotal role at the beginning of the Great Depression, which is arguably the most critical episode in the Fed's history. Benjamin Strong had passed away. Without him, policymakers struggled with this tension, with conflicting signals between the domestic stabilization needs they saw on the one hand and the gold standard precepts on the other. And these precepts impeded the interest rate reductions that might have stemmed the fall in the money supply and the catastrophic deflation that occurred, that raised real interest rates at the beginning of the Great Depression. Barry Eichengreen, a leading scholar of the interwar international monetary arrangements, argues that the gold standard broke down because its success required both credibility and cooperation, both of which were in short supply in the 1920s as the decade wore on due to domestic political developments in the major industrialized countries. And he argues that's why the gold standard succeeded before World War I, but changes domestically, extending the franchise to vote and other things in the 20s led to shifts in democratic power in those countries that led to the breakdown because of the unwillingness to negotiate that tension between domestic concerns and maintaining the gold standard the way they had in the past. So at the beginning of the 1930s, countries left the gold standard in succession because they found its defense too costly given their domestic political calculations. The result was misdirected policy, and misdirected Fed policy in particular, and that contributed to a decline of nearly 30% in the money supply and the price level between 1929 and 1933. So 30%. So you contracted a debt, you had to pay back in dollars that were worth 30% more than when you contracted that debt. This resulted in a broad shock to borrowers' ability to repay, and that weakened many banks, and it led many depositors to withdraw their funds from the weak banks that they saw. And the resulting runs led to waves of bank failures, and that further exacerbated the contraction. Now, current research, I have to be fair, suggests that there are other aspects of government policy that also may have played significant roles in the depth of the Depression, particularly the length of the Great Depression. But even having said that, in my view, monetary instability was clearly quite consequential, and it was clearly the fault of the Federal Reserve. As Fed governor in 2002, the current Fed chairman, Ben Bernanke, famously acknowledged and apologized for the Fed's role in the Great Depression. International considerations also played a role in what is arguably the second most crucial episode in the Fed's history, the great inflation that occurred from the late 60s through the early 1980s. International monetary arrangements were reconstructed after World War II under the so-called Bretton Woods It was called the gold exchange system. People weren't allowed to swap gold or redeem it, but countries were allowed to swap gold and for currency with each other and redeem currency with each other for gold. Currency values were fixed relative to gold, but intermittently there were discretionary changes by a country in its parity. They would revalue or devalue as they saw fit from time to time. And again, tension arose between domestic adjustment and the desire to defend a given parity in that system. Political pressures emerged on the Federal Reserve in the late 60s and the early 1970s that impeded our actions that would have prevented a rise in inflation. Now, rise in inflation, of course, necessitated some adjustment in these gold parities. Rather than make those requisite adjustments in the exchange value of the dollar in 1971, the Nixon administration simply abandoned convertibility of the dollar into gold, and Bretton Woods collapsed thereafter. And we've had essentially floating exchange rates in one form or another ever since. Central banks around the globe were forced to adapt to a world of fiat monies, in which the price stability ultimately rests solely on the credibility of government commitments to keeping inflation low. Tough actions were required to bring inflation back under control, but important lessons were learned as well. In particular, a measure of central bank independence proved invaluable in the fight against inflation. Institutional arrangements that helped insulate a central bank setting of the policy rate from electoral pressures, while at the same time clarifying the accountability for macroeconomic performance, allowed central banks to focus on their longer-run objectives rather than getting the current government elected at the next horizon. So the recent crisis has given rise to serious questions about central bank independence. It was in the news today, this audit the Fed thing. What's important for the credibility of the central bank's commitment to stabilize inflation is the central bank's ability to independently control its monetary liabilities. But that independence comes along with discretion over the central bank's asset portfolio as well. Unless prevented by some legal restrictions, a central bank's balance sheet, its asset portfolio, can be used to fund lending interventions. Those interventions constitute fiscal policy in the sense that if you just hold the monetary liabilities of the central bank constant, doing some lending requires selling some other asset, and usually that's a U.S. government security in the Fed's case. Selling that to the public. So it's as if we've sold Treasury securities to the public and used the proceeds to fund lending. To the extent that lending operations are viewed as rescuing the creditors of large financial institutions, the central bank risks becoming embroiled in distributional political disputes. And to the extent that expectations of such rescue operations distort incentives and encourage fragile financing arrangements, the central bank can legitimately, in my view, be accused of having contributed to the too-big-to-fail problem. The dilemma posed by central bank's asset portfolio plays out differently in different settings. The European Central Bank, I'd point out, for example, can at times face a politically awkward situation if they have to weigh in on the relative values of the sovereign debt of different Euro member states, a question that arises only because of the independent control they have and discretion they have over their asset portfolio. International considerations were also critical in the crisis of 2007 and 2008. The first special lending program introduced by the Federal Reserve, the term auction facility was called, or TAF as we abbreviated it, was dominated by foreign financial institutions. It was introduced in 2007. It auctioned off term credit at the Federal Reserve Bank's discount windows. Foreign institutions held large dollar-denominated positions in illiquid assets, such as mortgage-backed securities, and they had trouble funding these as counterparty credit risk premia rose and counterparties were pulling away from each other's in dollar funding markets. Banks in the U.S. had access to borrowing from the federal home loan banks, and they made major use of that source of funds when the credit premiums rose in the third quarter of 2007. Foreign banks did not, and that's why they turned in such large numbers to the term auction facility. More broadly, subprime mortgage risk was at the heart of the crisis, and it was held disproportionately by foreign investors and foreign financial institutions, along with, of course, our friends Fannie Mae and Freddie Mac, the U.S. housing intermediaries. The foreign financial institutions involved, arguably, were subject to the incentive distortions that accompany perceived public sector support. They were viewed as too big to fail in their own countries. Incompletely contained moral hazard in one country can infect and distort financial markets around the globe. For some time, central banks have been involved heavily in international negotiations aimed at leveling the regulatory playing field across countries in order to contain moral hazard across the globe. Post-crisis efforts to construct a more robust and sustainable financial regulatory regime have been mediated through several international forums that bring together central banks as well as relevant national regulators, a project fully in spirit with the GIC. But I think finding a balanced approach to financial stability is going to be a big challenge. So this has been a brief helicopter tour, if you will, of a century of U.S. central banking, one that's covered too much territory in a short amount of time in order to be able to examine any of the terrain in any depth. But what I've tried to do is highlight ways in which international considerations were not just another part of the story, but were really integral to the entire narrative. And I hope it illustrates the ways in which awareness of global interdependence is really essential for understanding the 100-year history of the Federal Reserve System. So I thank you for your attention. I thank you again for this wonderful award, and I'd be pleased to take questions. Shall we?
They want me to moderate the questions?
They do? Okay.
Is that right, George?
Yes, please.
All right. Moderate.
As the moderator, I get to ask the first one, right? Is that the deal, George, or not?
It's all right.
That's all right, George. You let me ask the first one. First, let me say thank you and congratulations on your award, richly deserved. Great speech going through the 100-year history of the Fed and weaving in the international. It was really nice. And my question is, you go back to 100 years ago, you pointed out that a key reason for the creation of the central bank was to cut off the fat tail of deflation, if you will. And then we think in terms of the Fed's biggest mistake in the 1930s is they didn't cut off the left tail of the distribution called deflation. And then the next biggest mistake would be after we left the gold standard, they didn't cut off the right tail of inflation. So effectively, you could say the Fed's 100 years has been mistakes in cutting off the tails in some respects. And obviously, we think in terms of where we are right now and looking at the distribution of inflation and what the Fed's dominant concern should be ordinarily, could you address the issue of what the fat tail is now? Are we in a liquidity trap? And what is your viewpoint on the coordination of monetary and fiscal policy in a liquidity trap?
Wow, fascinating question. So let me address it this way. So let me say first that an important feature of our history is that we've learned from our mistakes, and obviously the Great Depression was a cauterizing episode for the system and for the institution. And over the course of the 40s and then in the 50s, when we sort of regained our independence, it was an important factor in people reconstructing a sense of how to go about conducting monetary policy, because it's clear we had sort of the wrong theory in mind as we went into 1929. Our actions since then, in the 50s and 60s, was pretty good at containing inflation, and the Bretton Woods system had a role in that. After we left Bretton Woods, then this fear of inflation rose for sort of a long story. I don't need to go into it, but we took strong action to get that back down. So in both cases, we've sort of demonstrated we learned our lesson, demonstrated a commitment to preventing deflation, and then demonstrated a commitment to preventing inflation. And I think that's responsible. I think the extent to which people see that we've learned lessons from our past and how we've done it, and the willingness to take tough actions to act on those lessons, I think that's responsible for something that's been very surprising for me in the last 5 years. Given the expansion of our balance sheet, if you'd told me we were headed to a $4 trillion balance sheet, $4 trillion of outside money in the system, and that inflation expectations have remained stable, and apparently, as a result, inflation itself has remained remarkably stable, I wouldn't have put 99% probability on that. I would have put much less probability on that. I've been surprised by the stability of inflation and inflation expectations. I remain, though, as a central banker, sort of constitutionally unwilling to take that for granted. Because it does rest on credibility. And I think, I referenced Eichengreen's scholarship about the Great Depression. Credibility can erode. Things can change that lead people to question whether the commitment is there, both on the part of the central bank and on the part of government. And when I used government instead of central banks, when I talked about the necessity of, credible commitments, it was on purpose, because a fiscal authority can force a central bank's hand by running a big enough deficit. And if it can swamp our resolve. Even with the best resolve, you just do the arithmetic and it can swamp it. And so fiscal stability is essential. Some modest measure of fiscal stability on sustainability is essential for monetary stability. And to me, that's one of the things on the horizon that could conceivably threaten the success we've had at limiting inflation expectations and keeping inflation under control.
Okay, let me open it up. I will resist the urge for a follow-up. Who would like to have the next question? It can't be you, Charlie.
Anyone else at the Philly Fed is welcome, though. My good friends in Philadelphia.
Right here.
Hi, Chris Byrne.
Got Mike coming. Mike Alert.
Thanks. I just have a question on deflation, because we constantly refer to deflation as dangerous, and I mean, it's just this loaded word, and and without getting caught up in it, I mean, if deflation is so dangerous, then why doesn't the Fed march over to Walmart and tell them to stop these everyday low prices for Americans? And Costco is obviously a mortal threat to the economy. I mean, they're, Sam's Saving Club. And yet that goes into, those low prices go into an index that some people are trying to prop up. And so, my question is, we refer to deflation as bad, but deflation has brought an awful lot of good to this country as well. And so could you just give us some more precision on what's so bad about deflation, and is there some deflation that's good, and what exactly is the Fed trying to accomplish with this vilification of deflation? Thanks.
Well, let me make clear that I do not oppose everyday low prices. I'm in favor everyday low prices. So, and let me be clear about what we mean by deflation. So when economists use that term, they mean the average of all prices. So when you say average, you got to ask, all right, what are the weights in the basket? But it's the whole basket of goods that a typical consumer buys. What's the average price in terms of money? How many dollars on average do you need for this bundle of goods? And how does that change over time? So Walmart bringing about everyday low prices, there's something on the other side that's going up in price. Energy prices have gone up, for example. So you look at the whole portfolio and see whether the whole portfolio is going down. So it's not enough just to look at Walmart and see whether there's deflation in the works. And it's also not enough to look at them to decide whether it's good or bad. So Walmart can have everyday low prices, and they can be falling at 1 or 2%, but it's sort of not enough to just look at Walmart. You have to look at the whole basket. If they're going down relative to the basket, and the basket's chugging along at 1 or 2%, I think we're okay. We've got price stability. If their prices are going down at 1 or 2%, and the average is going down at 8% a year, as it did in 29 to 33, then we've got real problems. The problems on the deflation side are, first, if it's unanticipated, it's a huge shock to wealth. It's a huge transfer between borrowers and lenders. But even if it's anticipated, it's a problem because it's very difficult to lower interest rates below 1%. And so the real inflation-adjusted interest rate rises as deflation accelerates. So the real interest rate minus expected inflation. So if expected inflation is minus 8%, remember algebra, minus a minus is a plus. So, interest rates get to plus 8%, and they were plus 8% or 10% in the going into the Great Depression. On the other side, inflation is equally damaging, and they are, something that's true of deflation also is true of inflationary setting, that people have it's difficult to run an inflation that's steady at a high rate. And if it's not steady, then people are going to have a hard time knowing what things are worth. So you're setting a price, you're going to have it, you're going to post a price for a quarter. This is what you're offering, lumber at. And you don't know, kind of what's the value of money. And so it gums up the pricing function, it gums up allocations at a very microeconomic level across the economy. And on top of that, you have people skittering to avoid holding money. And that's costly, that's wasteful as well. So there's just tremendous problems with inflation as well. And for both reasons, I think vast literature on just what's bad about it and what's better about price stability. Hope I've been convincing.
In the back, all the way in the back, and then around to my left. You're up.
Hi, Jeffrey. Congratulations on your award. Where do your opinions come in terms of the quantitative easing actions that we have on the flow versus stock debate that seems to be going on in the popular press and among Federal Reserve officials as well?
Well, all right, so let me comment on the current, I think I know what you're talking about. We have a, so we have an asset, so we have an asset purchase program in place. A year or two ago, or with the QE2, 2 years ago, there was a debate about whether the effect was was due to the ultimate size or stock of how much we were going to end up having be purchased, or whether the flow amount, whether it mattered just sort of what the flow was. And I think it's pretty settled on the stock side that what matters is the cumulative purchases. So you think of purchasing assets as analogous to cutting the federal funds rate back when the federal funds rate was above zero. And so further purchases add more stimulus by doing the analog of cutting the federal funds rate more. There's this famous historical metaphor attributable to William McChesney Martin, the great chairman of the Federal Reserve System from 1951 through 1970, who said that the job of the Federal Reserve was to take away the punch bowl just as the party was getting going. So with these quantitative easing programs, what we are doing is adding punch, and the flow of purchases are essentially spiking the punch as we go forward. From that point of view, it matters how much cumulative spiking we do, and so the question of whether to reduce the pace of purchases or not is a question of whether to increase stimulus at a lower rate or not. So it's not a matter of cutting. So tapering is not a tightening of monetary policy in any meaningful sense, I believe. I think reducing the pace of purchases is easing monetary policy at a less rapid pace. I think that's an important thing to get across. So the tapering program has obviously been a hot topic of discussion this year. Unlike our previous purchase programs, we began this as an open-ended program where we just told you how much we were buying per month. In previous programs, we announced a fixed amount we were going to buy and also told you how much we'd buy a month. So that told you when we were going to stop. Because this is an open-ended program, we faced the problem right at the beginning, which is this challenge of how we were going to decide when to stop purchases, because nobody thinks we can go on forever doing this. So the criteria were laid out clearly in the statements last year when we adopted this program, and that we're going to do this until we see a substantial improvement in the outlook for labor market conditions. Now, obviously, those are terms of art, and obviously different reasonable people can disagree about the extent to which an improvement in the outlook for labor market conditions is substantial or not. And so we've been having that debate this year. But that's the criteria, and I think that's the criteria to focus on. And that's what I think the committee's been talking about this year. So I hope that clarifies to the degree we can. Point out that we can't see the future with perfect certainty, so there's a limit to how much I can clarify about the program.
You go ahead and take whatever you want.
Sure. Someone over here, someone at this table. You guys decide. All right. Decentralized decision here.
Hi, Don Rissmiller. In terms of what you just mentioned on the labor market, we focused on the unemployment rate, and while it may be a very good measure of the labor market, it's not perfect. What else should we be looking at? Employment population or labor force participation, or what else?
So I think that so questions about the unemployment rate and other labor market indicators. There's an obvious thing been remarked on these days that the labor force participation rate has been falling lately, and to the extent that, so holding employment growth constant, falling labor force participation versus constant labor force participation means smaller unemployment rate than it would have been if the labor force participation rate had been constant. Labor force participation rate is declining for reasons that have to do with demographics and shifts in the preferences of American workers. It's been going on for some time, and it predates the crisis. There is thought to be a kind of a cyclical effect of economic activity on labor force participation. My sense is that cyclical effects are well behind us at this point, and that the labor force participation rate is sort of the trend that you can attribute to, that's attributable to demographic factors. The aging of the workforce, for example, baby boom is getting into demographic age groups in which people typically fewer people typically are in the labor force. So if you look at labor force indicators more broadly, that's a grain of salt that you have to take into account with the unemployment rate. To my mind, the cumulative fall in the unemployment rate, the cumulative increase in employment are the key things. A lot of other indicators can buttress a view about whether those trends are sustainable or not, but those seem to be the key things. In addition, you can take a sort of a more sophisticated look and say, all right, take a period of time, end of 2014 or end of 2015, and look at what was your forecast, what was your outlook for labor market conditions in the fourth quarter of 2015, and what is your outlook now for labor market conditions in fourth quarter of 2015? Has that improved? And I think the answer is yes to that question as well. So I think on a number of different dimensions, for me personally, it looks like labor force conditions have improved pretty significantly.
The Fed considered, Rich Farr, has the Fed considered at all that there may be different brands of deflation? For instance, it's pretty clear if you look at the 1930s, that wholesale deflation across the board is bad, given the real interest rate. But look at the deflationary pressures today between the technological advances with the internet and GPS technology, robotics, healthcare, shale gas, you name it. Does it make sense for the Fed to say, well, we don't want deflation because look what happened in the 30s, so we're going to fight these deflationary pressures this time around? And if in the end we end up with oil prices higher just to get an aggregate inflation rate stable, have we done good or done bad?
Well, so I think, to say that, so you've used deflation in what to economists would be two different senses. So I alluded before to a broad basket of goods and what the average price of a broad basket of goods that consumers typically buy does. Now, the forces you're talking about are reducing the relative price of energy products in the U.S. relative to energy products elsewhere, relative to other products in the U.S. So that doesn't necessarily have to cause the whole broad basket to fall in value or rise in value. So I think you've used it two different ways, and I think you're right. We're concerned about the trends for the whole broad basket of goods. So that if there are forces that you've referred to as deflationary, forces like that emerge, we'd expect them to be, on average, counteracted by other prices that are going up in such a way that, the average price level is roughly, is going up at about 2% a year. Go back to this table here if we want, and then, yeah.
Dr. Locker, question for you. The balance sheet you said went from about $700 billion to about $4 trillion. But what's interesting is outside of the U.S., in Europe, India, and the developing world, that has a major impact. So when we talk about tapering, we get a cold and they get pneumonia. Could you comment on that? Meaning
Sure.
the perception of tapering in international markets.
I talked before in the operation of the gold standard how there was this tension between the adjustments you needed to preserve the gold parity of your own currency when shocks occurred, and the desire to insulate your domestic economy from the requisite adjustments needed to maintain that fixed exchange rate. So we don't, most countries don't run perfectly fixed exchange rates, but nonetheless, even without perfectly fixed exchange rates, the same tension arises between actions that influence the external value of a currency and actions that, that would buffer, or attempt to insulate domestic economic conditions from the reality of what's happening externally. That's up to emerging market and foreign policymakers, how they choose to adjust. And, I take markets' reactions to reflect a sense of their expectations about foreign policymakers' likely responses. Now, we certainly take into account that our actions have effects on other countries, but we run our monetary policy aimed at monetary stability here in the United States, macroeconomic stability here in the United States, and I think that's right, and I think that's what other countries have to do as well. In the middle here? Yeah, right in the middle here. Sorry. And then the guy back there.
Thank you, David Hoffman. This may be several questions. I'm going to try and fit into one, but we have a credit economy, not a money economy, so you've been expanding potential credit dramatically, but it's not really being used. Is there any fear at the Fed that if you expand it too much and people begin to fear the end of the cycle, that as we see downward pressures on inflation, that you could get deflation, and pumping up more potential credit actually doesn't solve that?
Say it again. What did you say about credit?
Well, the Federal Reserve's balance sheet is really potential credit for consumers. Consumers are not borrowing; the government's borrowing.
Well, no. So
demand is not
hold on,
expanding.
let me stop you there. I want to make sure I understand. So we have liabilities, and they're held by the public. Well, there's currency, and there's bank reserves.
So you've expanded asset prices dramatically, but not necessarily consumer prices or consumer demand.
So we've expanded the monetary liabilities that we supply to the economy. So take me from there.
So that has gone mainly into asset prices, and has not really gone into consumer demand because consumers are deleveraging. And if the fear of the end of the cycle were to cause consumers to get more conservative, and actually consumer prices were to fall further because they're being slipping, what would the Federal Reserve's sort of answer to that be?
So you're asking about a scenario in which consumer demand stops growing?
Because the more you increase credit, the more fear they may be about the consequences of how you unwind that process.
I see. Okay. I think I see where you're going. So, this gets to sort of deep questions about how credit markets work. It looks like consumers are looking after their balance sheets and doing what they can to make it align with, kind of their lifetime strategy. People accumulated a lot of debt before the crisis, obviously, and there's been a big adjustment process for people to get their debt back to something that's better aligned with their income prospects, better aligned with the real value of their assets, because houses have fallen in value, better aligned with their sense of risks to their own economic circumstances. And this is something I put a lot of emphasis on, I think is important. That, if you think of a consumer as kind of looking back over their experience and trying to get a sense of, all right, how should I manage my family's finances? In 2005, consumer looked back 20 years and they'd see 2 incredibly mild recessions, and just an long expansions, broad upward trend. And I think that consumers just have a much more apprehensive sense of the risks that a typical household faces in the labor market today. And I think that's legitimate. If you look back, I mean, we now know that the probability of a recession this size is probably bigger than we thought it was. And I think that's leading to more caution on consumers' parts, and I think they're managing their finances accordingly. And I think that's likely to be persistent. I don't see that evaporating in like a couple of quarters. So this is one of the reasons that my sense is that consumer spending is going to continue to grow at more like 2%. And that's why I was talking to my friend Bill Dunkelberg up here. I won't attribute anything to him, but this sense that the real GDP growth is going to pick up soon. I'm very skeptical about that. I know it's a popular forecast, but I'm skeptical. So I see 2% growth ahead. It's more likely than not.
You said there's an end to QE, but if QE expands forever, people may exaggerate that caution because of the fear of what happens at the end of QE or the reversal of QE, and that's really very. What is the Fed's solution to that outcome?
So the effect of all right, so let me address this head on. I think the effect of quantitative easing on asset prices and real economic activities is highly uncertain. I think a range of views from modest effect to virtually no effect are equally consistent with the data. And now, this idea that bubbles arise and crash, it's just really hard to ground that in a coherent economic model. So,
I think we got the last one coming up.
I think you covered a lot of the ground in answering Mr. Hoffman's question, but my question would be simple. What do you think is the biggest unintended consequence of QE?
Which one? That was just to buy me some time. I think one of the underappreciated, perhaps, consequences of QE has been the sense it's given rise to that the central bank has responsibility for real outcomes, real economic growth outcomes. I think the effect of monetary policy on real growth is, except for just us avoiding disasters that crunch things, as long as we're within a reasonably close to appropriate policy, I think our effects are modest and transitory. So the idea that we can have a sustained effect on the unemployment rate, at a horizon of a couple of years, I think is an unfortunate consequence of the degree to which we've conducted policy seemingly motivated by a desire to do what we can for the labor market. Thank you.
Thank you very much, and we hope we'll see you in another event of GIC. I want to thank Ben Gregg, the Executive Director, Amanda and Jill for all the logistical support. Thank you very much, and congratulations to you. Thank you.